Up next, we have Dr. Barry Burns, who is a businessman who has owned several small companies. His business background has taught him to focus on the bottom line, so his study of the financial markets was for one purpose only: to make profits. He started his studies of the markets under the direction of his father, Patrick F. Burns, who became independently wealthy through trading and had over 70 years of trading experience before passing away in 2005. Today, Barry's going to be showing us his favorite trading method of the last 10 years. Barry, it's all yours.
Okay, thank you very much. I appreciate that nice introduction. And I've been on here listening to the previous speakers, and wow, all I can say is, Kevin and all you guys, you are doing a great job over there at Real Traders, bringing such high quality educators and traders into the event. It is amazing. Great presentations, really good stuff. I hope everybody is just soaking it in and taking advantage of the education here today, because it is stellar. It really is. I'm very impressed. So what I'm going to be sharing with you today is going to be a little bit different than the previous speakers. And I have been as well. Let me get to the next slide here. There we go. First of all, I'm not selling anything today, so you can put your wallets away, your purses away. I am giving away my free 5-day video correspondence course, however, and we'll share with you how to get that. No cost at all. That's just my gift to everybody who's on the webinar today. As my gift to you, it's 5 days of video instruction, interactive quizzes at the end of each video. And in the fourth video, I actually give you one of my favorite trade setups. It is a very high win-loss ratio setup. It's one that I trade whenever it sets up. I always take this trade because it is such a high probability trade. And I'll be giving you the rules and the filters for that trade in video 4 of that free 5-day video correspondence course. So you can look forward to that. Yep, my father was a trader. That's absolutely right. It was his passion. So he started teaching me trading when I was 8. I'm 55 now, so 47 years of learning about the markets, and been. Oh, I don't know. You know, he already gave my introduction, so I won't go through all of this again. I will tell you, however, that what I'm going to be sharing with you is a methodology that's something that I've come up with after, again, 48 years of education, seeing a lot of things, learning a lot of things, a lot of different teachers, mentors, flying around the country, working with top traders one-on-one, giving them truckloads of money to do that. Learned a lot of great stuff. And, you know, there's many different ways to groom a cat. We'll say it the nice way. And there's many different ways of making money in the market. So there's no just one way. There's many different ways. And I've got friends who do all sorts of different things. And, you know, as the last speaker said, part of it is what suits your personality, what style suits your personality. So I put together something filtering out a lot of bad stuff, filtering out even some good stuff, and shows what works for me and what I like. And I'm able to trade this methodology using stocks. My dad was a stock trader, so I started with stocks. And then I got into futures, and then actually currencies after that, and commodities and options, and I do all of those. But the basis for trading all of those different financial vehicles and instruments is this methodology that I created. And this method can be used, it's based on technical analysis, can be used for all these different financial instruments. During the day, I day trade using this methodology. I also do short-term swing trading, same methodology. And then for my long-term investing in my retirement accounts, again, same methodology. So obviously very robust method, and it's because it's based on objective mathematics. So what I'm doing with this method is really one thing, and that is I'm defining what I call the energies in the markets, and these are revealed on charts. So as I said, I've learned from a lot of teach my students, everybody learns the exact same way. Everybody is able to read a chart the exact same way. There's really not much room for discretion at all. It either is or it isn't, and things are very rule-based and measured with these, what we call energies. And it's the fact that we're measuring the energies in the market, whatever market you're looking at, that allows it to be so robust. So there's 5 energies that I look for. So I base everything on technical analysis. And there's so much information available in the markets. In fact, that's one of the biggest things that I hear from a lot of traders who aren't making money yet, is that they say, gosh, I'm just suffering from information overload. There's way too much information. I don't know how to sort through it all. I'm feeling overwhelmed. And that's true. There's just huge mounds of information when it comes to trading the financial markets. And there's no way that you can sort through all of that. And the good news is you don't have to. In fact, one thing that I've noticed is since I've become a teacher, I've worked with some students one-on-one, and I've taught all over the country and done seminars and done chat rooms and been interviewed on the radios and interacted with traders all over the world, just tens of thousands, literally. So got a lot of feedback from people, and one of the things I've noticed is that, especially when I've consulted with people and firms and people who weren't making money, when I look at their charts tend to be too complicated, too complex. They're looking at too much stuff. So back when I first started teaching, I would did private one-on-one mentor. To be a profitable trader, you have to be able to trade with a clear mind, and you have to have very clear signals because you need to trade with confidence. And it's not that we're always going to be right. Everybody has their losses, but we want a good win-loss ratio. We want a good risk-reward ratio. Previous speakers talked about probability. Absolutely, that's what trading's all about, is putting the probabilities and the odds on our side. But to do that, you have to have a clear mind. And so the only way to do that is to take a lot of that junk off your charts if you're a chart trader, or however you decide to trade. But when I hired a floor trader at the CME to work with me and got an apartment out there in Chicago for a while. And what I noticed was those guys, the ones who were making money, and they weren't all making money, that's for sure, but the ones who were making money, their trading methods were very, very simple. And they relied primarily on disciplined money management, risk management, and again, just a very, very disciplined mindset. But as far as the number of things they looked at, they kept it very simple. They ignored 99% of the information that's available because they knew, well, there's also the law of diminishing returns. The more stuff you look at stops really improving your probabilities. In fact, if you demand too many things to line up for you before you take a trade, you'll never take a trade because market's just not that nice. Markets, tends to be kind of messy. And it's because it's people who trade the markets, and people are kind of messy. So the best we want to do is we want to put together a number of variables to create a probability scenario. So we need a system or a method that's complex enough that it has enough variables that it does establish a probability scenario that favors us. On the other hand, we don't want too many variables to overwhelm us, so that we're still able to trade with a clear mind and make quick decisions, especially if you're a day trader. Then that becomes especially critical. So I have settled on the number 5. And here's what I do. I look for these 5 energies, and I use technical analysis, and I use charts to measure the technical analysis. So the first one is trend. That simply refers to the direction of the market. My first question and I always look at the charts in the exact same order again, just to keep my mind very organized and orderly. So I look at a chart and I say, okay, number 1, do I want to buy or sell? And I'm looking to buy or short sell here. That's my first question. What's the direction of the market, and how long have we been going in that direction? The trend is your friend until the end. So I'm only interested in trading in the direction of the trend early in the trend. Late in the trend, I may even fade the trend. Question number 2. What is the momentum of that trend? That's the energy of momentum. So the first energy is trend, the second energy is momentum. That's the strength of the trend. So just because the market's going up does not necessarily mean that I want to buy, even if it's early in a new trend. I want to know, is it a strong trend or a weak trend? If it's a weak trend, odds are it will not continue. Trend is not a leading indicator. Trend just tells you what the direction of the market is up to this snapshot in time at which you're considering entering the market and taking a trade. But what we, of course, are more interested in is what the market's going to do after we get in. That's what really matters. So if the trend is weak, and let's say we're in an uptrend, then I don't expect that the market will make a higher high. On the other hand, if the trend is strong, momentum is behind the trend, then I say yes, I believe that it will make a higher high. Odds are it's going to make another higher high. Okay, and as long as I can do that, then I can start my money management program. Well, actually, we started from even before we get in, but we can at least get to pretty much a break-even point at that point in time. Okay, so energy 1, trend. Energy 2, momentum. Energy 3, cycles, timing, our highs and our lows. Markets don't go straight up or straight down. They tend to wiggle up and wiggle down. They're messy. The markets move a lot like life. You know, it's interesting. Life is 3 steps forward, 2 steps back. Markets move generally 3 steps forward, 2 steps back. Sometimes they go crazy and they go parabolic, and sometimes people go crazy and they go parabolic too and lose their minds. But the markets generally reflect human emotion and behavior, and even though there's so much computerized trading now, a huge amount of it actually, still reflects the human nature. So what we're doing is, once we've got a trend and it's strong and we're interested in taking that, then we have to ask the question, okay, what is the optimal time to enter that trend? Because let's say I buy a retrace, I want to get in on cycle low. But which low will be the last low before the market continues its uptrend? That's a tough question. That is the thing that a lot of people struggle with, especially amateurs. In fact, most amateurs I know, they don't even use any kind of timing tool. And so they might buy into a retrace of an uptrend, and then that turns into an ABC complex retrace or ABCDE complex retrace, and they end up getting stopped out, and then the market goes up after they get stopped out. And that's my teacher in Chicago. That's what he said to me. He says, Barry, retailers are often right, but at the wrong time. W.D. Gann, famous trader, once said that between time and price, time is more important. And that's a pretty profound statement, because a chart is a two-dimensional object. All it has is price and time. And yet most people completely neglect the timing element. They have no timing tools. They got all kinds of price tools, but they have no time tools. And since it's a two-dimensional object, price and time, if you don't have a great timing tool and know how to use it effectively, you are ignoring 50% of the information on that chart. Well, how can you establish a probability scenario if you're ignoring 50% of the information on the chart? And if W.D. Gann is right, you're ignoring the 50% that's more important than the other 50%. So absolutely critical. This is actually one of the things that I special in, is timing entries and exits, to not necessarily find, you know, the final high of a big market move or the final low of a big market move, but in a trend or in a momentum move, whatever type of setup that we're trading, finding the cycle low in order to partake in at least an impulse move, so that we don't get stopped out. And the way that I do that, I have a special technique that is mathematically based, and it's amazing. It works the closest thing to perfect I've ever seen. And by the way, if you're interested in cycle tool, I do sell it. I'm not selling it to you today because I'm actually going to be giving that away next Tuesday. I believe that's, yeah, next Tuesday, I think it's July 1st, isn't it? Anyway, next Tuesday, I'll be doing another webinar, and at that webinar, it's a free webinar, and I'll be giving away that timing indicator. And I'll also teach you how to use the timing indicator. So you'll get the indicator and the teaching for free. So if you sign up for the 5-day free video course, then you'll get on my list, and I'll send you the notification about that webinar. Fourth energy is support resistance. Support resistance is a blockage of the first three energies. And so we want to buy off support, we want to short off resistance, also use support resistance as profit targets. And finally, the fractal energy, or the energy of scale. And this is simply using multiple time frames. It's a very common practice among technical analysts, which I also do. It's not unique. However, the way I do it is unique. And so we'll see if we have time to get into that a little bit. I think we will. So when I get to that point in the presentation, I'll point out how I do it differently than most people I know. Okay, so that's it. We're measuring 5 energies in the market. Okay, now, as I said, my trading is very methodical, rule-based, objective, and so we need objective instruments to measure these energies. I don't want to just look at a chart and say, you know, just with my naked eye, well, gosh, it looks like it's moving up, so we're in an uptrend. No, that's discretionary. Someone else might look at it and say, well, we're in a downtrend, or I'm not sure, it looks choppy, or it's range bound. So what we need are instruments to objectively and mathematically measure these energies, so that when everybody looks at that instrument, they all get the same reading. It's just like I've got a friend who has a little 4-seater airplane, and he'll take me up and fly me over to Catalina Island. And I'm not a pilot, but he's been one for about 20 years at least, probably more than that by now. But anyway, he's got a lot of experience under his belt, and he can look out the window and he can tell you, you know, approximately how high he is and what the tilt of the airplane is from one wing to the other, or from the nose to the tail of the plane. You know, he's that experienced. He's got a good feel for it. And there's a lot of traders who are like that too, and are successful discretionary traders because of their experience. They know more than they know. But that's not duplicatable. So what we do is, in my method, we use instruments, so that, just like my friend's airplane, he's got instruments on his instrument panel, like the dashboard of a car. And he can look at that, and that will tell him exactly what his altitude is, exactly what the tilt of the plane is. And that's very, very precise. Everybody looking at those instruments will get the exact same answer. And so that's how we want to trade. We want to have our instrument panel, so to say, that gives us mathematically accurate and specific measurements for each one of these 5 energies. So there's no guesswork. So when you trade, you can trade with confidence and clarity and certainty. All right? So the instruments I use, I mean, we call these indicators. I like to call them instruments. In technical analysis and charting, of course, they're called indicators. And I know there's a lot of people out there who don't believe in indicators. They say, oh, indicators are all lagging, or they just tell you what price tells you anyway, yada, yada, yada. And again, there's some truth to that. In fact, I agree with those people about 75% of the way. And I have friends who trade without indicators, and they make money. Those same friends, I've learned their method, and I've traded their method with my indicators, and I've done better. And again, the reason is simply because it gives you such precision, and it's a shortcut. It's a shortcut to look at those things. Now, no one indicator is going to make me any money. I don't trust any of the indicators. I don't trust them at all. Are they money makers? No, they are not. They're simply instruments to measure each one of these energies. Okay, so for trend, I use a 50-period simple moving average. For momentum, I've got a momentum indicator I can share with you. For cycles, use an oscillator I'll be giving away on Tuesday's webinar. For support resistance, I use previous cycle highs and lows, previous wave highs and lows, floor trader pivots, Fibonacci levels, things like that. And for the fractal energy, Again, that's using multiple time frames, so I'll use a chart 3 times that of the setup chart. So that's in general. So if I'm intraday trading, for example, if I'm trading a 5-minute chart, I'd use a 15-minute chart for my fractal energy. If I'm doing longer term trading, like using a daily chart, then I go 5 to 1, and I'll use a weekly chart to confirm the action on the daily chart. Now, what's the purpose of all of this? Okay, let's bring it all together. So that's what I'm doing, but why and how? So the reason that I'm measuring these 5 energies is to determine a probability scenario that favors me, that favors you, as we're talking about. So we're coming full circle here. And here's how I do it. At each potential entry point I'm considering, I ask myself one question. Remember, keep it simple. How many of those 5 energies are aligned, all saying buy or all saying sell at the same moment I'm considering taking a position? Then I give each setup a score of 1 to 5, depending on how many of the energies are aligned. Obviously, the higher the score, the higher I consider the probability of success. Now, I need a minimum of 4 of the 5 energies to indicate a buy or a sell. 3 might seem like a majority. It's not. It's not, because trading is it's not a zero-sum game, right? It's a net loss game, a business, I should say. I hate using the word game for trading. It's not a game at all. It's a serious business. So you've got costs, you've got commissions, you've got slippage, you've got your spreads, you've got your fixed overhead, etc. So every time we take a trade, we've immediately lost money. Even if we're selling, options or whatever, that's fine. That's potential gain still, but you've got an overhead, you got a cost of doing money, of doing trades. So therefore, we want at least a 4 out of 5 score. 5 out of 5 is even better. I liken this to taking each trade to court. We need 5 independent witnesses to establish a preponderance of the evidence. And that's the whole key right there. In fact, the operative word is independent. Again, I don't trust these indicators. So whatever one indicator says, I don't give a rat's left patootie what any one indicator says. It's useless. What it does accurately measure is the energy, but there's no correlation between what that energy is and whether I'm going to make money or not. Now, what if 2 energies say buy, as measured by the instruments or the indicators? Still not good enough. I don't trust them that much. What if 3 say it? Still not good enough. I don't trust them. 4? Okay. Pretty interesting. Now I'm starting to feel better. 5, I'm in every time. But here's the operative word, is independent. That's the operative word. That's the reason this works. See, if I were to put just 5 trend indicators on my chart, well, that's not going to increase my probability, because they're all just measuring trend. And trend alone, it's the energy, not the indicators that matter. They're still only measuring one energy, which is direction. And that by itself is meaningless with regard to what will happen after I get in. The reason that this methodology works is those 5 energies that I mentioned, those 5 energies are, each one is uncorrelated to the other 4. So they're all measuring different things. That's what makes it significant when all 5 say buy or all 5 say sell. Okay, so it's like I say, I consider it like taking a trade to court. If you have the accused there, and the accused brother says, no, he didn't do it, and his mom says he didn't do it, and his girlfriend says he didn't do it, and his best friend says he didn't do it, that's not really very reliable testimony, because they're all related to each other and they're all related to the accused. Now, a more compelling testimony would be if there's 5 people who get up on the stand, none of them know the accused, and none of them know each other, and they all say, yeah, he did it. Okay, that's compelling testimony. That's a good analogy for what we've got here. So just as an example, the first 2 energies. You'll see, and I see this all the time, price trend going up, And sometimes energy number 2, momentum will also be going up. Okay, that's great. They're both aligned. We have a strong trend. Other times, price trend is going up. Momentum is flat, zeroing out. Not good, not a strong trend. Other times, price trend will be going up. Momentum is actually going down in the exact opposite direction of price trend. So they're completely uncorrelated. They can do exact opposite things. And that's true of all 5, and that's why when all 5 align, okay, it's significant. Okay, so that's the principle. Now let's look at some charts here and show you visually what it looks like, because technical analysis is very visual. And let me get my little laser dot out here. All right, there we go. So energy number 1, trend. So I use the 50-period simple moving average as my instrument or indicator for trend. Now, I get questioned on that a lot because people say, well, isn't the traditional concept of trend higher highs and higher lows? And they say, well, I don't know if it's traditional. I've heard it for many years, but it's wrong. And they'll say, well, how can you say so definitively it's wrong? And I say, oh, well, it's a word. Trend is a word. And when you want to learn the definition of a word, you go to a dictionary. The dictionary says trend is defined this way: to extend in a general direction. Think of that. Extend in a general direction. So trend is by definition a long-term move. Higher high, here we have a higher low and a higher high. Is that the extended general direction of this market? No, that's just a complex retrace against the extended general direction, which is the trend, which is down. The 50-period simple moving average measures that, and it's down. Now, trend is a lagging indicator, and you have to have a long-term indicator to measure trend because trend is long-term. One of the problems with that is then it does become a lagging indicator, and you can even see that here. It doesn't start angling down until after price has already been going down. So that's a problem, but on the other hand, lagging indicator is an important thing to have on your chart. There's actually a benefit for a lagging indicator. What is that? I remember one of my teachers telling me that. Took me a year to figure out what he meant. I thought he was nuts. But what I finally understood was that lagging indicators are lagging because they require more data to confirm a signal, but because they require more data to confirm a signal, they become more accurate. And so therefore you get accuracy. What so-called leading indicators are not always leading. Okay, there are some indicators that can lead the market sometimes. Nothing always leads the market. Nothing can tell the future all the time. But the potentially leading indicators tend to be less accurate. So we'll get into that here in just a second. So you get a lot of amateurs who would look at a chart like this and they'd say, oh, hey, there's a left shoulder, there's a head, there's a right shoulder, that's a reverse head and shoulders pattern. And they would be completely out of their minds. That is not the reverse head and shoulder pattern at all. Does not even fit the definition of it. But they will take this along, and that's fine because as professional traders, we're going to fade the amateurs. This is where, have you ever had the experience where you just felt you are perfectly wrong? It's like it's astounding how perfectly wrong all your trades are. Okay, I remember those days. I had those days too early in my career. It's like, wow, how can I be wrong so perfectly? In fact, I remember even one time I thought, okay, what I'll do is I'll just take all my trade signals, but whatever it says go long, I'm going to go short. And every time my trade signals I think I want to go short, I'm going to buy. And so I thought, that's got to be perfect because I'm almost perfectly wrong. And even that didn't work. And there's a reason for that, by the way. I'll write an article on that one sometimes because it's a pretty interesting concept. But anyway, by the way, in the 5-day free video course, I'll explain why this is not a reverse head and shoulders pattern. But this is great. And so a lot of amateur traders, they'll either think it's reverse head and shoulders or they'll think, hey, we're starting an uptrend, higher low. Well, as professionals, we know, no, we're not. The trend is down, and we're looking to trade down, so we're going to take the opposite side of the amateur's trade. We're going to fade, or we're going to short here. That's a great place to short. That's a great place to short as well. In fact, this trade right here, That's the trade that I'm going to show you on day 4 of the 5-day free video course. And as you can see, turns out quite nicely. Okay, the second energy then is momentum. Now, momentum is one of those potentially leading indicators. Why? Because moves tend to get weak toward the end. Now, the operative word there is tend. Not always. We do sometimes finish major moves with great strength, but we can also read those, and those are called climactic moves. So we look for the end of moves in either one of two ways. Momentum shifts, which I'm going to show you now, or climactic moves. Okay, and sometimes they just kind of roll over, and well, that's fine too. Nothing works all the time. But these are the signals we look for. We trade our signals. We don't trade the market. You know, we trade the signals. So, and the reason for that is because that's all we have. We don't know what the market's going to do. We can only read our signals. And then we use our risk management, money management, hedging, and all that sort of thing to protect ourselves. So here we have a higher high, higher low, higher high, higher low, 50 MAs angling up all the time. Remember, even if you use price action as your trend indicator, it's still not leading, right? It's just showing what is at that snapshot in time. And there's no indication here as to whether you're going to make a higher high at this point, if this is the hard right edge of the screen, except momentum. Momentum measures the strength of the trend. Again, trends tend to get weak toward the end. So here we have a much higher high in price. Momentum, oh, see, well, first of all, let's look at this low first. When this low comes in, momentum holds above the 0 line. So we would say, okay, I'm interested in buying that because we have a strong trend. Make a higher high, much higher high. Momentum, that's your first indication right there. Again, indication, indicator, doesn't tell, but indicates. Equal high, getting weak. Then we go to our next higher low. Momentum makes a lower low and goes to 0. No strength left in this trend. Therefore, on this low, we would say, no, I'm not going to buy that one. In fact, when we get up here, we're probably going to even take that short now because we know there's going to be amateurs buying this because they're going to still think it's an uptrend. And so there's going to be people we can catch here. And we know there's no strength behind it. We get engulfing candlestick pattern. We can short here, or we can short here when momentum actually stays below 0 for a while. Or if we want to be more conservative, wait till the price breaks below the 50 MA, get a nice spike top candlestick and very low momentum, negative momentum, and we can short there. 3 opportunities to get in on the right side. Okay, but the earliest one is always the best as far as getting the best value, the best price, the best risk-reward ratio. Cycles is energy number 3. Cycles, like I said, markets don't move straight up or straight down. They wiggle up and they wiggle down. And so this is just a partial thing of my cycle indicator. It's not the whole thing. But basically, we just want to show that you know, we want to buy the lows, we want to buy the lows, we want to buy the lows. And it is possible to do that very accurately, in fact, astoundingly accurately. And that's something that's, I think, very unique that I have to offer. A lot of people have had a tough time figuring out how to know when is that final low. In other words, would you want to buy this one? Well, probably not, because it goes and takes out that low. How would you know to buy this low instead of that one? Okay, that's what I'll show you on Tuesday. Cycles are great, but all the energies, remember, each one of those energies are useless. You have to use them all together. So here's an example of why you can't just trade cycles. There's cycle high, low, that's nice. But look, the market has no momentum, and so it's a narrow range market. So we don't trade every cycle high and every cycle low. We want to make sure there's going to be a good risk-reward ratio and that there's going to be some movement, some range. Trend is up, yeah, that's fine, but do I want to buy there? No. Do I want to short there? No. So you got to put all the energies together. That's the only way you have probability scenario. Here's another one, support resistance, energy number 4. Okay, in this case I'm giving the example of Fibonacci. We drew from that high to that low, so the lines only become significant after this low. If you notice, even just a cursory look, you can see that price bars, sometimes they bounce off of support resistance, the Fibonacci levels. Other times they just slice right through them, right? I mean, for example, right here, here's your 23.6 level. Price just sliced right through it, didn't even acknowledge its existence. So again, you can't trade support resistance by itself. You need to use the energies together and only trade the significant ones where all the energies align. So for time's sake, let's just look at this last arrow here, and we'll give you an example of how that works. So how would we determine this has a high probability of being a high to go ahead and short? All right, so first, what is the resistance level? Well, it's the 50% Fibonacci retracement, which is a very, very, very good level. And also is this previous wave high. So it's a cluster, double thick ceiling, so it's a little harder to break through. Why is it harder to break through? By the way, when I teach, see, for me, doing back testing is not good enough because that's essentially just curve fitting, and everybody knows that. So then they came up with out-of-sample forward testing to help avoid that. Okay, that improves it a bit, but still it's all on historical data. It can still be curve fitting, and every regulatory statement you read, everywhere you go on every brokerage firm's website and so forth says past performance, is not indicative of future results. So, I mean, that kind of blows everything out of the water when they say that. So, that kind of testing can be helpful, but you have to add a third element, and that third element is, does it make market sense? In other words, people are trading the market. The market is a huge auction place. Is there a logical reason that something would occur? So, for example, I just mentioned clusters. When we talk about clusters, people say, oh yeah, clusters are double thick ceilings or floors, and so therefore, there's two lines. Ooh, wow, two lines. So therefore, they're more likely to hold. It's not because they're two lines. Lines mean nothing. In fact, they're not even lines. In reality, they're zones, not lines. But the reason that clusters do tend to work is because you'll have some people who are looking at this 50 Fibonacci retracement. You'll have other people who are looking at this high, the swing high. Therefore, what's happening is you've got a lot of people, the more clusters that come together based on different support resistance techniques, the more people in the market are looking at that and are more likely to respond to it. Either take profits into it, or in this case, short sell off of it, or whatever. But the point is, it's not because there's two lines there. It's because there's more people, more market participants responding to that level because more people are seeing it because people are using different techniques, okay? So I'm really big on explaining things like that in everything so that you don't think that these lines on the chart mean anything. It's not the lines, it's the people. And if you've ever been down to the exchanges, on the floor with the traders and the pits and all that kind of stuff, then you get a real feel for, oh, this is the market. Oh my gosh. Okay, and wow, those guys up there, that company and that pension plan and this whale, and that's the market. Okay, and it's an eye-opener. As screen traders, we can start to believe that all these lines and wiggles actually, do something. So they're just indicators of what people are doing. Okay, so anyway, let's get back to this. So the resistance is strong, cluster. Okay, so that's good. Still not enough to trade off of. Number two, though, let's add up some numbers here, add up the probability. We've got an engulfing candlestick pattern for a high. Okay, that's pretty good, but I've seen those fail. But again, it adds a little bit of probability. Number three, the 50 MA is angling down. So we're looking to go short. That's our directional indicator. Now, it's kind of a strange situation because we're above the 50 MA, but it doesn't matter. It's still angling down. Okay, and there's a reason that happens. I explained that in the 5-day video course too. So we're still looking to take shorts. Number three, we've got our timing indicator here turned red, meaning it's time to put in a high. Okay, that's very significant. And number four, what about strength? Well, when the market's been going down, momentum indicators pull far below the zero line, far below the zero line. But as it goes up, it barely gets above the zero line. What's that mean? That means that in this market right now, there's strength to the downside, weakness on the up moves, on the correctional moves. So therefore, we expect more range on the follow through to the downside than we do on the upside. So weak moves coming up into a cluster of resistance is more likely to hold. To break through support resistance, you need strength. And that's why on the way down, we're able to break through both the 38 and the 23 and go all the way back down to this level here. Okay, so that's how you put together all the energies. Finally, let's talk about the fractal energy, energy number 5. Again, that just means multiple time frames. Here I've got a 100-tick chart of the NQ, a 300-tick chart of the NQ. These are really fast charts, but when I day trade, I like to trade fast. Actually, now I'm using, they've changed tick data and so forth, so now I'm using a 200-tick chart, 600-tick chart, and a 1800-tick chart when I trade the NQs, but I prefer the E-minis just because they cost more. So we look at this chart. This is our setup chart first, and then we're going to confirm with the fractal chart 3 times the time frame. So price is above the 50 MA, then it meanders below the 50 MA. Okay, so that means number 1, what? We're looking to go short. All right, at this point, we get engulfing candlestick. By the way, the 50 MA can also provide support resistance. It's providing resistance here. Engulfing candlestick high, and at the same time as a cycle high. Momentum below 0, so strength is to the downside. So everything's looking good there. Now we need to confirm with the next higher time frame. So, oh yeah, I was going to tell you how I did this differently than most people. So a lot of people I know, they use multiple time frames, but the way they do it is they say they'll only take the trade in the direction of trend of the higher time frame. Okay, that doesn't make a lot of sense to me. Here's why. Number 1, we're dealing with a 3 times slower chart over here. So there's only 1 bar here for every 3 bars here, all right? And then we already discovered how trend is a lagging indicator. So when you use a lagging indicator on a 3 times slower chart, what you're doing is you're creating less correlation in the movement between these 2 charts. I kind of liken it to being a loose steering wheel. Have you ever had an old car? My first car, I was born in Detroit, and poor boy, I wasn't that poor, but we had a nice little 2-bedroom house. Brick house in good old thriving metropolis known as Detroit, the cute, quaint little French colony on the river, Detroit, Michigan. And anyway, you know, we're middle class basically. But as a kid, I didn't have a lot of money and I couldn't afford a lot, so I got a junker when I got my first car. And it had a lot of play in the steering wheel. So I could turn it, I don't know, 5 or 10 degrees to the right, 5 or 10 degrees to the left, and it would not turn the front tires. The car would just keep going straight. Well, that's the same thing here. If you use a lagging indicator on a 3 times slower chart, there's going to be a lot of play between the movement on your setup chart and the confirmation on the longer term chart. We want action here to result in action here immediately. We want a tight correlation. So instead of using the lagging indicator trend to confirm my trade on the short term, I go to the long term and I use momentum and confirm it with the momentum indicator, because remember, momentum is the potentially leading indicator. So in this case, I just need momentum to be angling down since I'm looking to go short, and it is, and therefore I could take the trade. All right, so high probability trading. That's what it's all about. Hey, everything works sometimes. You know, I've got filters for my trades that sometimes I'll say, oh, here's a good setup, but if this happens, then you can't take it. And you know what? Sometimes it'll still work when that filter is there, but most of the time it won't. So everything works sometimes. We don't care. Nothing works all the times. There's no way you're going to avoid having some losses. With your money on the line, you want to know, is there a high probability it'll work this time? This time meaning whenever you're taking a trade. So how do we determine that? We simply wait for the alignment of the 5 energies to put the odds on your side. It's very simple. 1, 2, 3, 4, 5, and I'm going through it slowly with you because you're being introduced to it for the first time, so I really have to just go step by step. But there's only 5 elements here. So when I look at my charts, or when my students look at their charts, this stuff, it's so clear, it's so obvious, you don't even count. You just look at the chart and you can instantly recognize it. And that's especially important for day traders. And I got invited out to one of the biggest trading clubs in America, and I won't mention which one it was. Good people though, great, loved it, had a great time. They were very good to me, and they're a great club. But they were putting together a a nice trading system, and it was probably pretty good. I don't know. I didn't read through the whole thing because it was over 200 pages when they showed it to me, and they still weren't done with it. So, I can't evaluate that. All I can tell you is that seems like a little bit of overkill to me personally. So my trading system's 1 sentence long. All right, again. And we do it always in this order. Look at a chart. What's the trend? And again, we have the instruments we're looking for objective measurements. It's black or white. It either is or it isn't. And by the way, if you're not sure, then it isn't. Okay? If you're not sure, the answer is no. You only take trades that are perfectly clear to you. So, number 1, trend. Number 2, is it a strong trend or a weak trend? If it's a strong trend, we're still interested. 3, when's the best time to enter that trend? I want to get in on the final cycle low or the final cycle high so I don't get stopped out of a complex retrace. Then I want to be buying or shorting off of support or resistance. And finally, I will not take the trade unless it's confirmed by momentum on the longer term time frame. Okay, let me give you one last example here. We'll just walk through it all 5 steps. So here's our setup chart on the left. Here's our confirmation or fractal energy on the right. 200 tick chart, 600 tick chart, 3-to-1 ratio. All right, and yeah, I'm sorry these are old charts. Obviously these are just screen captures from a long, long time ago. But this stuff still works today. Still doing it, trading futures, stocks. Use it to analyze my option positions, commodities, Forex, everything. So market's going down, trending down. Okay, again, we only want to take a trade in the direction of the trend early in the trend. By the way, early, like all my terms, have a very precise definition. Early means the first 2 retraces in a new trend. So here we pop above the 50 MA for the first time, and we retrace. First retrace in a potentially new trend. All right, so trend, yes. Let's score the trade. That's number 1. We got a score of 1 so far. That's not enough. Then we ask ourselves, number 2, is it a strong trend or a weak trend? We look at momentum down here as the market retraces. Yes, momentum holds well above the 0 line. So it's a strong trend. We have a score of 2. 3, timing. When do we want to get in? There's our little cycle indicator, and goes from red to green, goes up. Again, I'll be giving you this indicator on Tuesday. So great, that's the time that we want to enter. So we got a score of 3. 4, we want to be bouncing off a support level because we're trading corrections. Again, we want strong impulse moves in the direction of the trend, weak retracement moves that will bounce off a support that red line to the 50 Fibonacci level. Excellent. Got something to bounce off of to stop the move down. And then number 5, we go to the next higher time frame, and we will not trade without this. Now, here's an example. I mentioned this. Here it just happens to be an example. Trend indicator is down. Momentum indicator is up. Cycle indicator is up. So I don't care about the trend. Trend is down. That would keep me out of the trade if I use that. But no, that's a lagging indicator. I want to use a potentially leading indicator. Momentum is going up. That correlates more tightly with the action over here. Therefore, it allows me to take that trade to go long. That would be a 5 out of 5 trade. And that's pretty much how simple it is. So the method is robust and adaptable. I already mentioned how I use the same 5 energy method for trading stocks, commodities, options, currencies, and futures. I use it also for all the different time intervals, whether I'm investing, swing trading, or day trading. It's very simple. very objective, pretty much counting to 5. Now, some people at this point ask me, hey, you know, a lot of trading systems are designed specifically for options or commodities or day trading or e-minis or stocks or forex. And yeah, that's right, and that's fine. You know, there's nothing wrong with that. So then they ask, well, how can this be so, you know, adaptable where you can do it with all of these things? And the reason's actually very simple. It's because all we're doing is measuring the energies in the market. And remember, the indicators are not the magic. They're just the instruments that measure the energy. They tell us what those energies are. So it's kind of like, the best example I can think of is if I were to put a tortoise on the ground and it started crawling, and I wanted to measure the direction of that tortoise. Okay, what instrument would I use? I would use a compass. I could look at the compass and say, okay, that tortoise is crawling east. Great. I pick up the tortoise and I put a completely different kind of animal down there, completely. A cheetah. Okay, cheetah, totally different animal, right? Cheetahs can literally go 70 miles an hour. It's crazy, and that's without a Ferrari. They just run 70 miles an hour. Now, if I wanted to measure the trend of that cheetah, what instrument would I use? I'd use the same instrument. I could still use a compass, right? It wouldn't matter because the compass just measures the direction of anything that's moving. So it's the same thing here. We take a chart, blank chart, we put our instruments on there to measure the energies. They're not going to measure anything yet. Then we put a market on it, and we put an interval to that market. And then those instruments will measure the energies of that market in that interval. So it adapts to it completely. So I've got a complete trading plan. What I teach is not theory. It is, I give you the reasons behind things, as I said. I give you the rationale and the logic so that I find that learning happens a lot better if you understand the whys. It's easier to remember things if you don't have to just remember, oh, here's the pattern, here's this, here's that, but you actually know why. Then it just seems to stick in your brain better. Also, knowing the reasons why and having logical reasons gives you more confidence because you say, well, that makes sense. And then, of course, I encourage electronic simulation trading for a while first so that you can start to see the method does work and build your confidence up, and then go ahead and start trading with a small account and build up over time. I also teach people I've got a little biofeedback mechanism that I use. I don't actually hook you up to wires or anything, but I have a way of, in my courses, I also teach trading psychology, very important. Psychology of trading is the thing that trips up most people. I have a doctorate in hypnotherapy and neurolinguistic programming, and I've used that to help people with trading. In my courses, the very first course I have, I teach the psychology of trading along with the methodology. I don't sell it separately because you need both. So why would I sell them separately? So I include that in there as well. And then I also give people a scorecard so you can keep track of your trades and actually keep track of the score, but that's very easy. So as I promised, I'm not selling anything today, not even offering anything for sale, but I am giving you my free 5-day video correspondence course. So you get a video, it's a short video, maybe 15 minutes each day, with instruction teaching you something new. Already told you some of the things I'll be teaching you, why that reverse head and shoulders was not a reverse head and shoulders, why a higher low is not the start of a new uptrend, and why that will mess you up more often than not and help you trade perfectly imperfect. Also, the trade where the price gets above a downward angling 50 MA, give you my favorite trade setup, all that for free. Just go to realtraderswebinar.com/top-dog, and you can get started on that today. So I got 3 minutes. I don't have time for a lot of questions. I'll answer a couple, but if you have any questions, feel free to email me at barry@topdogtrading.com, and I will be very happy to answer any and all questions that come in. So, oh, good. They already posted. Kevin posted my link there. So since I have about 2 minutes, let's see if there's any questions. Here's the questions. Wow. That is small print. I've been trading for so long, looking at monitors, my eyes are not what they used to be. So let's see if there's a couple here. Oh, John says the link's not working. Okay, maybe retest that. You can just type it into your browser. Okay. Oh, here's a good one. JP asked, he's on Thinkorswim. Thinkorswim is great. Are there indicators I can use there? Yeah. I don't use any proprietary indicators, by the way. So everything I use is on every charting platform I've ever seen. So yeah, no problem. You can do this on pretty much any charting platform. I use very standard indicators, nothing proprietary. And I've got a lot of traders using Thinkorswim. It's a great one. Absolutely. In fact, that's actually one of the best ones to use because one of my students actually customized some Thinkorswim indicators. So if you end up getting my course later on or whatever, I'll send those to you for free. Anyone who has Thinkorswim, I can do that for you. Okay. Yes, yeah. If you signed up for the 5-day video course, you will be getting a link. In fact, every day when I send you a, I'll send you an email once a day that'll have the link to the video for the day. Okay. But there'll also be another link to sign up for Tuesday's webinar in every one of those. And then as the webinar gets closer, I'll just send you an extra reminder about that too. So thank you, Stephen. Appreciate that. Oops, I'm out of time. Dang it. Got good questions here too. Shoot. Okay. Well, I just hit 12 high noon here in beautiful California in La La Land. So that means that I'm going to have to skedaddle. Thank you, though. A lot of nice comments here, guys. Thank you very much for that. And yeah, send your questions to me at barry@topdogtrading.com, and I'll be happy to answer. I love communicating with traders, so do not feel shy to do that. And thank you guys at Real Traders. Love you guys. You're doing an amazing job, and everybody make sure to come back tomorrow and hear the speakers then too. There's a great lineup of speakers tomorrow.
Barry, thank you so much. And guys, as always, Barry is the man. Definitely go to that link, realtraderswebinar.com/topdog. And once you do, Barry does another webinar on Tuesday, which you definitely want to attend. We get such unbelievable feedback from everybody that does attend that. So again, we just want to say thank you to Barry from Top Dog Trading.